Hello everyone. Welcome to Development Economics 2. As we know that we have been discussing this whole idea about financial instability in a globalized world, and we have already covered the idea of globalization because to set the context, in which context we are talking about, we have discussed the whole concept of globalization, its various aspects, consequences, and so on. Today, in this class, we are going to focus on the idea of financial stability or financial instability. More so from the perspective of how to conceptualize this, and so on. Okay. The learning objectives of today's sessions are as follows on your screen. We will talk about the concept of financial instability and some relevant related issues, some issues that are relevant and related to finance, and we'll talk about how to understand the very idea of financial stability, what are the key principles on which we need to define the idea of financial stability. As you can see, I have put the word IN in a bracket because it's kind of connected. Financial stability and financial instability, they're kind of two sides of the same coin. And then towards the end, we'll talk briefly about some select financial crises. Now, we don't need to have a separate context or motivation to talk about finance. Have you had this experience in your life? You have entered a shop of, let's say, you are going to buy a laptop, but the price of the laptop is a bit too much, where you think your current income may not be sufficient enough to support it. And I'm sure you have experienced it, but it need not be the case that you have come back home empty-handed. The moment you are thinking, okay, what to do? It's so expensive. And the salesperson realizes it and immediately says, sir, not to worry, or ma'am, not to worry, we have Bajaj Finance. Or the same has happened when you are somebody's thinking to buy a house. The same can actually happen when somebody is thinking of a startup. Somebody is thinking of, okay, I need to launch a new project. They can actually, borrow money from the market. And it's like financing the investment. It's like financing your consumption. It's like financing your education. So we are, as we speak, surrounded by finance. Maybe the laptop you're using to watch this particular class is bought using some sort of loan or finance on credit card maybe. So we don't need a separate context and motivation. Nevertheless, the whole idea of financial instability is something that we really need to worry about, right? Now, it's a major concern. And because it's happening in a connected world, it's more of a concern. Remember that example that we have used earlier, that you are getting a connection between different houses where you can borrow, let's say, the fuel from one house to another, and this way all the houses are connected. So if one house needs some sort of fuel that suddenly it can get, but then what if when you actually are in the need of this, somebody say, okay, give me back the fuel you have borrowed from me. Or there's no guarantee the person you have lent will actually not default. When you actually need, the person may say, I don't have it. So something like that sort can also happen. So in a interconnected world, financial instability can be very, very serious problem. Now, it's a concern for developing countries, but the time has changed. It's not just concern for developing countries. It's pretty much concern for the developed countries as well. Therefore, we will talk about the financial crisis and it's the seriousness of it and how to think about the financial instability in a globalized context, but more so because financial crisis and economic consequences also have serious political consequences. You don't have to really browse your memory much. Think of what happened in Sri Lanka and what has still been happening. And a few months ago, you have seen people have kind of came out of their house and protested in large numbers. You have seen Sri Lankan cricketers on the street protesting against the country's debt crisis and the whole economic crisis. So it has serious political implications. Now, by now you are well versed with Google Ngram Viewer. So you understand what this particular chart is showing us. It is showing us the increasing importance of the word financial crisis in the books written in English, in the title of the books written in English, right? And if you pay a closer attention, it's not just very recent past. You also have seen this in the late 19th century. You have seen this rise in the importance of the word financial crisis in the titles of the books written in English in around 1920s, 1930s. That's because it's a Great Depression time, and also in the recent past. And as this class is being recorded, this is unfolding in reality. This bank has been shut down now, the Silicon Valley Corporation. And the matter is such a serious matter because there is apparently some other news which of course needs to be verified, that given this, the short form of this bank is SVB, apparently some Indian bank, which short form is SVC, also got into trouble because people kind of confused it. And it seems, of course, this needs to be verified if this is the case, that the bank had to announce that, look, it's not to worry, please don't spread misinformation. Now, Silicon Valley Bank became the biggest US bank failure in more than a decade. Why are we talking about it today? Because we are in a globally interconnected world. And Indian startups are worried about the fact that this bank actually collapsed because they have parked their deposits there. Now, what does finance offer? See, finance does a very interesting thing. There are two things it does. Think of a time machine. If you have a time machine, you can travel between different time periods, right? Think of finance working as an economic time machine. You are standing today, you want to buy a laptop, you want to buy a house, you don't have enough income today, you are taking loan. Finance for a car, finance for home, you're an investor taking loan finance for your new project. Who will pay it off? You will have to. But which you? The future you. So the present you is borrowing in a way from the future you. So this is exactly how finance works as an economic time machine, that you can, that helping the savers can transport their today's surplus income into the future. Similarly, the borrowers have access to future earnings today. This is exactly how finance works. And the other issue, if there is an emergency, I'm sure you guys have seen this advertisement that children are playing at home, suddenly the boy hits the ball, then it hits different furniture, all the furniture break down at the same time. And the man of the house or the person earning member of the house, in this advertisement particularly, he seems very chilled out because he thinks, not to worry, there's this particular personal loan available, so we'll easily get it done, and they get their room refurnished, etc. Now think of, this is an advertisement, but the idea of that is that in emergency, finance can really help you. In illness, in some sort of, let's say, natural calamity, and all that stuff. So finance really does these two things at a very core level. Now, by providing these two kinds of services, a well-tuned financial system therefore smooths away life's sharpest ups and downs because you are protected against all odds in a way, and making an uncertain world more predictable. And this is exactly where finance is fascinating, because finance itself brings in its own uncertainties. While it says that it can actually, reduce some sort of uncertainty, finance itself has its own uncertainties. In addition to that, when investors seek out for people and companies with best ideas, if you have the finance, that can actually work as an engine of growth. Now, can finance invite trouble? Well, of course it can. Because finance can also be terrorizing you. Yes, it can terrorize you. Think about you're about to sleep at midnight, and then suddenly there's a notification on your mobile screen, and you saw the bank that you have invested your money is collapsing. Of course, you'll lose the sleep of the night, and you'll think what to do. The whole night, maybe you are withdrawing the money, and it's not you alone. The panic will be spread across the countries, transboundaries, right? It's connected world. Something of that sort happens when there's a run on the bank or bank run. And if there is a bubble burst or markets crash, the plans paved years into the future, that also will be destroyed. Now, therefore, you actually need a stable financial market or financial stability. The question that you need to think about, that is it really an irregular thing that you have financial crisis, or is it a more of a regular thing? Well, the recent experiences can actually tell us it can happen on a very regular basis. It's not like an offshoot that, okay, things are fine in general, suddenly something bad happens. This sort of the tendency in the system it's like a prone to crisis. That's how your system seems to be working. And that is exactly why you need to be worried about financial instability. Now, it's your turn. Think of some basic functions of finance. As you can recall, we have talked about two kinds of things. It, of course, bridges the gap between different time periods. It works like an intertemporal instrument. You want to transfer some sort of surplus from today to tomorrow, or you want to transfer some sort of tomorrow surplus into today. So when you are, saving, you are parking your money, which you will withdraw later in the future. When you are borrowing, it is your future self that will pay back the money from future surplus income. And also, we have talked about the emergencies where, finance can actually help you. Okay, so now we'll talk about how to define financial instability or financial stability. There are some relevant issues here. One, A barter economy is less effective and efficient in allocating scarce resources than which is the case for an economy with the ability to use financial claims on future real resources. Money, second point, money is not necessarily the most desirable store of value. You can actually store your wealth in different other non-monetary financial forms. You can have mutual funds, you can have other stuff. So except in the very short run of when chips are down, things are going bad, money is a good source of store of value at that time, but otherwise it's not that a great store of value. So modern finance actually provides us the substitute for money that provide temporary and reversible intertemporal means of payment and store of value services. Once again, I would like to draw your attention to some of the advertisements that we see. You have seen people talking about mutual funds. Somebody says that, what do I do? Some friend said, do it. Then the person says, it is good. They say, of course it is good. They talk about all that, and the person says, sahi hai. But I want to draw your attention to what happens after that in the advertisement. They actually also give a precaution to all of us that please read all the papers carefully because the markets are prone to a lot of ups and downs. Now, this is exactly why we are talking about this whole idea of financial instability. Okay, the third point. Many of the services provided by money and finance are both private and public goods, right? Now, one more important and interesting thing. The fiat money, when you give somebody, let's say, 100 rupee note, there is no issue of trust here because the currency has the signature of the central bank's governor. The state, in turn, actually is guaranteeing us that the value is there in that particular thing. It will not lose its value. But in case of finance, the issue of trust is brought back because it's like a promise. Finance involves human promises to pay back specific amounts of fiat money in the future. Somebody has borrowed money from you, the person disappears from the face of earth, and you do not know where he is or she is. So there's the default that is happening. The big corporations actually also default. There's a big default in case of various big loans, and you can just Google and see there's so many defaulters. Okay. Finance, therefore, existentially embodies uncertainty about human trust. Modern finance provides societies with effective, although imperfect, effective but imperfect, mechanism for transforming, pricing, and allocating economic and financial uncertainties and risk. Let me give you one interesting information. We know that there is something called credit, right? You ask for credit. The word credit actually originates from the Latin word credere. The word credere implies to believe or to trust. So by the very origin of the word credit, it is connected to the idea of trust. So when it comes to finance, the whole idea of trust is brought into the story, and that is exactly why things become fundamentally uncertain. You never know what's going to happen. Now, of course, there's uncertainty and all that, so there's benefit and cost. Finance enhances the private and social benefits of fiat money. Of course, because in part it enlarges the pool of liquidity available for production. Suppose you have to borrow from somebody in your family, but availability of finance makes it like you can borrow from anywhere. You can borrow from bank A, bank B, bank C, from any other place. So it literally enlarges the pool of liquidity available for production, for consumption, for exchanges. Also, in part, it facilitates and enhances the efficiency of intertemporal economic process, intertemporal implying between different time periods. On the other side, trust is fragile. It can, and often enough it does, become a source of potential financial instability because of the issue of trust. There's a default, and which in the wrong circumstances can affect both individual and social welfare. Suppose you do not trust the bank that you have deposited your money in. You think the bank is getting into big trouble. You want to withdraw. It can generate a series of incidents following that. Everybody who has deposited their money in the bank, they start withdrawing because they have lost trust in that bank. Or you have a particular company share, suddenly then some news comes in and you're like, okay, I don't trust this company anymore. I want to sell off my share. And there is there's a rush that everybody is trying to sell off their share. And the value of the share drops. People holding that share might lose a lot of things. And then they have their own calculation what to do about in that circumstances. Now, exactly because finance supports and facilitates real economic processes, these potential instabilities may well extend to the real economy. Think about it. The story of you inviting your relatives and friends at home, you need the fuel, you have this facility that you can take from here, there, or maybe you have lent somebody some amount of fuel, and you have told that on that day I would need. When you actually need, your relatives or guests are coming, this fellow actually disappears. Then you have no idea what to do. But think about what happens then. Because you invited people, you have already ordered some other vegetables, some other food items. Now you're not able to cook them. You have to go and cancel that order. Now you see the chain reactions that's happening because of all this default and all these problems. This is just a very simplest example to give you a sense of what can happen. But the things are much more complicated than this. This similarly example that is on your screen, as we are discussing the run on the bank. Let's say the savers remove their deposit from a certain bank. The confidence about the bank falls. Then the more people want to remove savings. The more they want to do that, more and more people want to remove their savings. As a result, the banks are going to run out of liquidity. They'll be short of liquidity. As that happens, more people would like to kind of take away their deposit because they're losing trust and so on. This is a vicious circle that goes on. Now, this is called the run on the banks. Okay, now it's time for you to think about why do you think finance existentially embodies uncertainty? Now, this is a question we will not answer immediately. We want you to go back to some of these discussions we have had and think by your own thought process or some experience of your own experiences around you, and think about why do you think finance brings in uncertainty in an inbuilt manner. It's like embodied in it. Okay. In the process of understanding financial stability, there are some key principles for defining financial stability. Look, it's a broad concept, okay? And it covers various aspects of finance. A, infrastructure, B, institutions, and C, markets. So it covers various aspects of finance. It can't define only in terms of the institution or in terms of the infrastructure or in terms of markets. They all have to be put together, and that's how you have to think about the financial stability. Now, financial stability, alongside or apart from allocating resources and risks, mobilizing savings, and facilitating wealth accumulation, apart from these things, they should also imply that the system of payment throughout the economy functions smoothly. It's not just about allocation, it is also about the functioning here. That has to be smooth. Third, it is not exactly always about the absence of actual financial crisis. It should not be like, okay, there's no financial crisis, things are all right. It's not exactly that. It's more about when the chips are down, in the bad time. So when actually there is some possibility of a crisis emerging, what happens then? So we have written here that it is not only about the absence of actual financial crisis, but also about the ability to the financial system to limit and contain and to deal with the emergence of imbalances, which could be like before those imbalances create a new threat or to itself or economic processes. Before that happens, can the system contain it? Can the system control it? Can the system limit it, deal with it? Okay, think about this example. In human body, there are always some sort of disease or the other. If you have better immunity system, even if there is some sort of disease, if your body is functioning properly, it will take care of itself. Then you would not need an intervention, maybe. But if little intervention can help, still it's okay. If your body has severe issues, then even in case with intervention, it may not function well. So, that kind of analogy you can think of, that okay, there is no disease, fine. But that's not exactly what your body stability is, what we mean by that here. We implies when there is a chance of instability, how your body is coping up with that, and is it able to contain it? Is it able to limit it? Is it able to deal with the problems? Similarly, in case of the financial market, financial stability, before the imbalances become a big crisis or something. Okay. Now, fourth point, the financial stability should be couched in terms of the potential consequences for the real economy. It's not like that some company, has an issue, or some 5-6 companies have issue, some banks have issue. We need to think about, is it going to affect the larger economy, right? If it doesn't, then it's not really a systemic issue. It's the issue of certain particular institutions, certain particular enterprises, and so on. So we are saying that disturbances in financial markets or at individual financial institutions need not be considered as threats to financial stability if they are not expected to damage economic activity at large. Now, the fifth point is financial stability is to be thought of as occurring along a continuum. This whole idea of continuum is an important thing. It's not a static thing, okay? You have to think in a continuum thing. Why it is important? Because fundamentally, finance involves uncertainty. It's today, tomorrow, and so on. It's a dynamic thing. Some instrument which appears to be working now may not be working tomorrow, in a proper expected manner. So it evolves. So there are new innovations of financial engineering, financial instruments, and so on. Okay, and also it's composed of many interlinked and evolutionary elements, infrastructure, institutions, and markets. So therefore, financial stability is expectations-based, dynamic, and also dependent on many parts of the system working reasonably well. It's a holistic thing that you have to think about. So finally, we are in a position to define it. A financial system is in a range of stability whenever it is capable of facilitating rather than impeding the performance of an economy. So it facilitates the performance of an economy. And also remember, dissipating the financial imbalances that arise endogenously, either from within or as a result of significant adverse and unanticipated events, maybe a pandemic, maybe a war. So A, to facilitate, B, to protect itself, to manage the unforeseen crisis. Okay, a question for you then. What do you mean by financial stability? We have discussed in greater detail, and you can go back to some of the previous slides and actually identify what you mean by financial stability. In the last segment of today's presentation, we are going to briefly talk about some of the well-known crises in the history. Now, the credit crisis of 1772. This crisis, originated in London, but then, of course, it spread very quickly. By the mid-1760s, they had accumulated a lot of wealth and so on, also thanks to their own colonial processes. Now, this created an aura of over-optimism. And remember, this whole idea of over-optimism and a lot of credit expansion happened then. It is very common in various financial crises. The hype came to an end with certain incidents when this person, Alexander Fordyce, who was one of the partners of British banking house, Neil James and Fordyce and Down, the person fled to France to escape his debt repayments. Now, of course, this news quickly spread and triggered a banking panic in England, and then everything else followed. It kind of spread to Scotland, Netherlands, and other parts of Europe, and the British American colonies as well. Historians have said this crisis was very significant because they have actually linked it with what followed in terms of Boston Tea Party protest and the American Revolution, in fact. We want you to go and check about the Boston Tea Party, then perhaps you'll understand the implication of the picture that is on your screen. It's a very interesting story. The next big crisis that we're going to talk about, which is the biggest of the 20th century, the Great Depression in the late 1920s. It kind of stayed for about 10 years. Now, people say that a lot of people believe that it started with the Wall Street financial market crash of 1929, and then it continued later. Government policies did not work well, and so on. But there are various other explanations of Great Depression. The whole macroeconomics, as we know, the Keynesian economics, came out of this whole context of Great Depression. This depression lasted about 10 years. We had loss of income, we had loss of employment, loss of output. It was the biggest in the 20th century and biggest crisis so far. During the peak of this crisis, the unemployment rate actually touched about 25% in the United States. So 1 out of every 4 person would be unemployed. And you can see on your screen so many people queuing for a piece of bread, and there are famous films made on that context, Modern Times, Grapes of Wrath, and so on. You can watch this, you'll understand the context better. The next we're going to talk about is the OPEC oil price shock of 1973. This crisis began with the OPEC countries, they kind of, which are consisting of the Arab nations, they decided to retaliate against the United States, which was kind of supplying arms to the Israel during the fourth Arab-Israel war. They said, no more oil. OPEC countries declared an oil embargo, abruptly halting oil exports to the United States and its allies. Of course, you can understand this will shoot up the price of oil, right? This will shoot up the price of the oil. This caused a major oil shortage and severe spike in the oil prices, which led to crisis, right? Now we come to the Asian crisis of 1997. This crisis originated in Thailand in 1997, which quickly spread to rest of the East Asia and its trading partners. There are a lot of speculative capital that has come to East Asian tigers by now. Why? Because these countries like Thailand, Indonesia, Malaysia, Singapore, Hong Kong, South Korea, they were known as the Asian tigers. They had been doing really well. A lot of foreign funds came into these countries and triggered an era of optimism. Remember, era of optimism, a lot of fund coming in. Now that resulted in an overextension of credit and too much debt accumulation in those countries. What happens? Thailand does something in July 1997. It announces that it will not follow the fixed exchange rate against the United States that it had been following. This started a new process. What happens? They started a wave of panic across the Asian countries, financial markets, and quickly it led to the widespread reversal of billions of dollars of foreign investment. You have a picture on your screen. You can see what was happening where. As this panic unfurled in the markets and investors kind of grew very worried about possible bankruptcies of East Asian governments, they feared that a worldwide financial meltdown can actually happen. Well, IMF also had helped, but some critics says it was IMF policies at the first place, World Bank policies at the first place, which kind of led to this kind of problems. But then IMF also had a bailout package. Again, the last crisis we are going to talk about is the crisis of 2007 and 8. It is known as the Great Recession. It has been the most severe financial crisis since the Great Depression. And it seems the effect of that crisis is still lingering on. It's triggered by the collapse of the housing bubble in the United States. Happened in the United States, spread across the world, across all the countries, right? Now, the crisis resulted in the collapse of Lehman Brothers and brought many key financial institutions and businesses to the brink of collapse and required government bailouts of unprecedented proportion. Huge bailout happened at that time so that the crisis does not really become much bigger, but the crisis has become bigger by then. It had affected many other countries. It took almost a decade for things to return to normal, and it wiped away millions of jobs and billions of dollars of income along the way. All the crises that we have discussed, there are certain commonalities. There's always crisis that follows, there's a good phase, a phase of optimism, then there's that followed by a kind of crisis. A question that emerges is, does it mean that the crisis that we see after a good time is linked with the good time itself? We will have this discussion in some of the later classes, but keep this in mind, that can it be the case that the problems of the bad times, or the seeds of the bad times are sown in the good times itself? A very interesting chart on your screen, that post-global crisis in the United States, the states where unemployment rate increased relatively more were also the states where people in those states Googled about anti-stress medication relatively more. So the states with higher unemployment increase happened to be the states where people had Google searched about anti-stress medication. Now this kind of shows the correlation between financial crisis, economic crisis, and even mental crisis, depression, and so on and so forth. So in the conclusion, what we have here, that the financial instability is a major concern. It has always been so, and we have seen historically that way. There are various relevant issues which are involved in understanding finance and its functioning. We need to define financial instability. There are some key principles which we have discussed. Crisis is not irregular, and we have seen that it recurs. So this is a kind of question that, again, we have mentioned earlier also, that you need to think about. Is crisis an offshoot, or is it more regular in nature? What is the road ahead for us? In the upcoming sessions, we'll actually talk about the financial instability hypothesis, international institutions and financial instability, and last but not the least, the link between globalization and financial instability. Thank you.